Hello and welcome to this week's Market Outlook webinar. If you're watching the recorded version of this, it was held on Wednesday the 22nd of March at 12:30 in the afternoon. So this is one that we run every week with Aondo, and we've sort of mixed it up a little bit. It's a look at what markets are interesting, where the opportunities might be in the next couple of days, look back at what's been going on, but also a bit of education and strategy stuff as well, just to try and squash as much as possible into this 30-minute webinar. All of these get recorded, so if you're watching the recorded version, you can attend them live every week. With the platform we use is Aondo's Trade Hub platform. Aondo are maybe better known for social trading, where you can copy other traders, and I do a regular webinar twice a month with them on that, but you can also trade yourself, in the normal way, and I think that they're pretty competitive. In this day and age, all spread betting companies are pretty much the same when it comes to spreads, so we're going to use their platform today and their charting, which is pretty good, to take a look at what's been going on in markets. That's it. I think there's nothing I've missed, is there? Right, so I'll just juggle my screens around now. I think that risk warning has been up for long enough, so let's just flip onto the other screen and take a look at the markets. Here we go. Right, so what you should see on your screen now is the DAX. I did a trade on the DAX this morning. It's in profit, but it's just not a very good trade technically, but I'll talk about that in a minute. It's a bit of a bottom fishing trade. I think we should start off clearly by what went on in US stock markets yesterday. So let's take a look. I was saying just before we sort of started the recording officially, until yesterday, there had been, I think it was more than 100 days, was it 105 or 110 days, I can't remember the details, where the US stock market had not fallen by 1% or more. I think it's the S&P 500 it was based on. But yesterday, of course, this is the Dow we're looking at now, the Wall Street market. Market absolutely fell off a cliff. So where was it? So we came into yesterday around about 20,950 and sort of bobbled as low. Well, this is the out of hours market, but was trading below 20,700 during the day. It slipped a bit lower overnight, and it's got a bit steadier since then. But it's interesting. It's always an interesting wake-up call, isn't it? Let's take our big picture view. And if we go back and we look at, there we go, since the election, the US election, the market has just been grinding its way higher with the odd surge now and again. So yesterday's sell-off, you can see the size of the candle, was much bigger than anything we've had since that US election. It's always weird when stuff like this happens. My job in the past used to be, talking about markets to the media and stuff. And the problem always is, I think, you always want to fit a narrative to why the market's done this. I think I retweeted someone yesterday. Market does. Someone says X, market falls, therefore X caused the fall, and that's not always the case. I was reading the Times business section just before we came on today to see what reasons they were talking about, and they were saying it's the fact that I think fund managers are saying that stocks have been more overvalued now at any point in the 17 years since the tech bubble, so that clearly spooked people, and also I think concerns that President Trump's tax plans are going to be very hard to put into action, and then we're not going to see the sort of growth that maybe some people were expecting in the US markets. Who knows? Still wait and see. You've got to trade whatever's happening, haven't we? But I think it's too early, to call the top. I think it's only, famous last words, it's only the beginning of March that US stock markets made all-time highs. So we're, what, 3 weeks off that? Is the top really in? It wouldn't surprise me if we had another go at having a look at that top up there. So, but I think it's clearly when we see volatility like this, it makes a much more interesting markets, I think, from a trading point of view. But let's flip it over to the S&P. Let's chuck some trend lines in on this. Let's see where we are in the overall trend. So what I'm going to do is not that button there. So if if we took it off that sort of spiky low, the overnight low on presidential election results day, I think that's not going to give us maybe the best view of the trend. So the trend I prefer is this one here, from when the market rallied higher after the election, dipped a bit in December, and had a bit more of a sort of a normal move up since then. So let's plonk our trend line on and see what that looks like. There we go. So we're looking something like this underneath all the lows. Perfect. There we go. So in the overnight market, the S&P has had a little dibble below that trend line, but I think for all intents and purposes, I would say that bit of the trend is still up. So that's what, probably a 3-month-ish trend, 3 and a bit month trend is still up. So it does make, I think, for an interesting position from here going forwards. You know, if the market's based on that trend line, if the market's going to bounce from anywhere, this is probably the place. If you've attended these webinars in the past, you know that I'm not necessarily the biggest fan of trend lines. I think if you're using them as an absolute level, it's going to be, I don't think it's going to be that successful. But I'll always try and put trend lines on charts just so I'm trying to identify in my head, you know, which way the trend clearly is and to trade with the trend. I think we get maybe, let's look at some sort of previous highs and lows as some levels to watch this afternoon. So that was the plunge. This is the S&P we're looking at. So this was an hourly chart we were looking at here. There's lots of support back there. Okay, it has, again, it's dibbled below it in the overnight market. But I think, you know, at times like this, when we see such big sell-offs, we need to give markets maybe a little bit of leeway. There we go. So 23.38-ish, something like that, was a previous big level from mid-Feb. It's only a month ago. And then after that, you know, as is always the case when we see strong moves up, you know, we have lots of levels left on the way back. So I think we've got lots of support, pockets of support left on the S&P, and the Dow will be the same, you know, from this rally up that we've seen. So it's really interesting. The aggressive trade here is to buy it. That is the aggressive trade, and put a stop underneath these most recent lows, the overnight lows, or let's say beyond 23.33 on the S&P, and a similar sort of level on the Dow. So if you thought, well, this move has been overdone, well, if it's been overdone, it shouldn't go down any lower, should it? So we should see something of a recovery from here. Personally, I think today, if the market doesn't go lower, it'll just chop. You know, we'll see an element of adjustment to these new levels, and let's see what happens next. So as ever, there's never a rush to do a trade. You know, you've got to find the one that is right for your particular strategy. But you know, if someone was going to take the view, okay, the market was overdone, clearly it shouldn't go any lower. So I think there are clearly some big levels to watch this afternoon. In Europe, I've done a couple of trades on the DAX, the German index, which I'll talk about when we have a look at that. And it did start off this morning by slipping lower, but we didn't really have any follow through, and that was what thought to me, well, actually maybe there's an opportunity there. So it should be this similar sort of thing when the US market's open. And of course, I think they're opening at 1:30 at the moment, aren't they? Because we haven't put our clocks back, and they have, or forward, whichever way the clocks go. But when our clocks change, we'll be back to a 2:30 opening. But it's really interesting, you know, there's the size of that fall. But again, it was, if you look on social media and stuff like that, there was a lot of, you know, people do get a bit overexcited, I think, when we have days like this. You know, I think we do need to keep it in perspective, because we're back to where we were a month ago, you know, and after the rises we've seen, clearly it was a market that was overdue cooling off. It just carried on, I think, a lot higher than plenty of us thought. But let's see. So big levels to watch this afternoon. Those are overnight lows, you know, really the obvious ones. Let's talk a bit about the educational thing we're doing today, stochastics. Okay, so stochastics is one of the myriads of squiggly lines you can put underneath charts. And I think in the past we've talked about the RSI, the relative strength index or indicator. I can never remember which one. And that's a nice, simple, overbought, oversold oscillator. Let's talk a bit about something that's a bit more sophisticated. So I'm going to I've got a real history with stochastics. Saying that, I did have to look up and remind myself of the definitions today. But when I first sort of got involved in markets in the mid-90s, and I did my technical analyst exam, I really fell in love with stochastics, and I thought I discovered the holy grail. And I spent far too many evenings at work. I used to work for a technical analysis software company back then, back testing this stuff, and I was in my 20s. I should have been out doing much more exciting things than looking at stochastics on charts. But I thought I discovered the holy grail. Needless to say, it wasn't. But they still have their uses. So here are the stochastics, and you can see, you know, as this is my big bugbear with all these sort of indicators. Look how many different flavors of stochastic we've got. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 different types of stochastics. And I think, as you know, clearly, you know, as software does all this stuff for us, programmers come up with more and more ways of analyzing markets. And I think the problem is, when you first start, you can just end up not seeing the wood for the trees. What we're going to look at is the slow stochastic. Okay, stochastic slow. I think that's, I would say, is maybe the more traditional stochastic, but what do I know? And then again, let's flip it over to a daily. So let's start from the top down view, really. So what are we on? We're on the S&P, aren't we? So there's the stochastics. And what I'm going to do, what have I got? Let me just change the settings. So 5 533 is a common setting. That's a 5-day stochastic. 1066 is another common setting. So what these lines are, this is where we're going to get a little bit technical, so brace yourselves. So you have in stochastics, there are 3 calculations that go in stochastics. Percentage D and percentage DN, but only 2 lines get shown. If this stuff doesn't float your boat, don't worry about it, because software does it all for you. So percentage K is almost like an RSI. So if percentage K in this example is a 5-day percentage K, if percentage K is above, let's say it's 80%, it's saying that 80% of the time in the last 5 days, today the close now has been higher than the close the day before, and so it goes on. So in a market that's trending higher, percentage K will have a high reading, but percentage K doesn't get shown on the chart, because then you have this thing called percentage D, which is this thing here. So percentage D, the first line that gets drawn, is in this example, a 3-day moving average of percentage K. And then the second line that gets drawn is a 3-day moving average of the 3-day moving average. Hopefully that all makes sense. So percentage K is the raw calculation, and it's a bit like an RSI. And then what these 2 lines do is just smooth out that calculation, to try and take out some of the bumps and the volatility in the market. So as I say, 533 is a popular one, 5-day stochastic. 1066 is another popular one. Okay, is that all clear? Good. There will be a test at 1 o'clock. And how it works is it's quite similar in a way, on the one hand, to moving averages, to how we get our signals. So one way of using stochastics, probably the more popular way, is the crossover technique. So again, if you've ever looked at moving averages, like a 200-day and a 50-day moving average, for example, when the 50 crosses up above the 200, it's a buy signal. When the 50 falls below the 200, it's a sell signal. So it's a similar sort of thing with stochastics. It reckons that when the stochastics, like down here, when they've been oversold, and again we have these oversold bands, traditionally 70%, above 70% overbought, the market's gone too far, below 30% oversold, the market's gone down too far. So with stochastics we have those, and when it's down here and it hooks and crosses up, that's our buy signal. So you can see it hopefully on the chart there. It didn't do too badly. It was that candle there back on the 9th of March, so a couple of weeks ago. And then let's try and find a half decent sell signal. There we go, this one here, back in Jan. Okay, when the stochastic is overbought and hooks down, that's our sell signal. The problem is, as usual, with all of these indicators, if the market starts trending like an absolute trending thing, these things will give a signal to go the other way too soon. So that sell signal there, 15th of Feb, you'd gone short if you were following your stochastic crossovers, but the market ramped up higher, as you can see, for the next couple of weeks. So if you're going to trade off these sort of things, I'd say an aggressive stop should be, or could be, over the high of the day when the signal comes out. Yeah, because if you're going to go short, well, by definition, the market needs to start turning over. If the market starts pushing higher, then maybe you're a little bit too early. Okay, but it's a way, again, like RSIs, of trying to get a feel on how overbought, oversold the market is. Yeah, so we'll keep these on the charts while we're going through. So at the moment, on the S&P, the latest sell signal was there, which has turned out, in hindsight, pretty well. At the moment, we're heading towards oversold, but the market, the S&P, needs to stabilize and have a little bit of a up move, I think, to get these things to cross over. But that's how stochastics work. So they're not too bad. I think they give fewer signals than the RSI. So again, because this percentage K thing is smoothed out, it takes away some of the more erratic movements. It's called a slow stochastic, and it's got these smoothing factors in, and slow because it shouldn't whip around so much. But it's a different way of looking at markets. And for me, I must admit, I don't look at it much these days. But if I had to look at two oscillators, it would be the RSI and the slow stochastic would be the 2 I'd use, because I think they're quite a good way of just getting at the temperature or the heat in the market. Okay, let's go back to markets. So let's just talk about stock markets for a bit, because clearly, we've had a pretty crazy 24 hours. So this is now an hourly stochastic, because we flipped this to an hourly chart. So on an hourly stochastic, again, if you wanted to maybe have less signals and filter out some of the noise, you could flip over to a 10, I suppose, couldn't you? You can make it whatever you want to do, but I'll just stick with the industry standards. 1066 is always a popular one. There we go. Okay, so our sell signal Oh, that nailed it. Look at that. Perfect. I take back all I said about stochastics. So the last sell signal we had was yesterday morning? Yeah, 9 o'clock yesterday morning on the slow stochastic. And a buy signal, there we go, early hours this morning, 3 o'clock this morning. And I think I've talked about this idea of divergence in the past. Just one more last thing I forgot, where where the market moves to a high, then moves higher still. The stochastic here is making lower highs. So this is bearish divergence. I think we've talked about it when we've looked at the RSI in the past. So again, this can be a suggestion. That signal didn't work when the market is moving higher, but the stochastic isn't. It can be a suggestion that the market really is running out of steam. So there we go. That's stochastic. So clearly, the big levels to watch. Like I say, if you're trading the S&P or the US markets this afternoon, keep an eye on those overnight lows to see what happens. But I think after a fall like yesterday, it would not surprise me in the slightest if we had an afternoon of just chop this afternoon. Let's look at the Dow, just to look at the equivalent sort of levels for the US market. We'll take a look at that. I'm doing this, I'm up in North Wales at the moment, so I'm doing this, I did say at the beginning, on Welsh broadband, which is a little bit slower than my broadband, but it's less congested. But so that's it. There's a slight delay now and again. That's why it's just a little bit slow. So on the Dow, similar sort of moves. This is the hourly chart as the S&P. We've seen there's been a low made overnight, so the market did move lower, a little bit lower overnight. So we pushed a little bit lower, but we have seen some stability. So let's see what happens this afternoon. Let's bring it back to Europe and look at some of the European markets. Let's start off with the FTSE, because I was talking about the trend in the S&P and the Dow, and the trend line. The market's basically come back to test the trend line. I think it's a similar sort of thing on the FTSE. Let's just zoom it in again on the FTSE. Here we go. So we've got our Trump presidential election craziness there. If we took it off here, maybe for the FTSE, slightly sort of calmer level. So let me pick on my my trend. We're seeing similar sort of things. So we really are. You could say. I think it has poked below it today. The FTSE. There you go. So it's poked below that trend line, but we are in, I think, sort of bounce or bust territory for these markets. But on the FTSE, there's big support back here off these lows, around about, where's that? About 72.60 lows from the 9th of March. We've got support back here, 71.90. So I would still favour a bounce from here, looking at these levels. Let's flip it over, and the FTSE is still. Look how overbought the FTSE is according to our 10-day stochastic. Because the FTSE has been a bit stronger in the last couple of weeks than US markets were. Let's look on the hourlies and see if there's any other levels that are maybe a bit hidden away. Now, it's still really that big level back there, isn't it? That big level from a couple of weeks ago, ahead of 72.60. So let's see what happens. And the final stock market we'll do is the DAX, German 30. Unlike the other markets, I mentioned this a couple of times, that the DAX hasn't broken out to all-time highs. It's still capped by, zoom it out, there we go, those old big levels from 2015, so a couple of years ago, up at sort of 12,400. Clearly we've seen a good run for the DAX since again, election time, but it hasn't broken out to these all-time highs. So if I talk about the trade I did this morning on the DAX, and whilst it is in profit, it's about 30 points in profit at the moment. It really wasn't a very good trade, to be honest, in hindsight, because I did it because I thought the move was overdone yesterday. So I came in today thinking, okay, the move is overdone. Let's see if there's a buying opportunity. So if I flip it over, let's say a 5-minute chart, a really short-term chart. So I was looking at it this morning. So the DAX, because again it's a 24-hour market with Aondo. As the US market slipped lower last night, the DAX was slipping lower. But coming into today, in the overnight market, there'd been a bit of stability ahead of 11,860. So I thought, well, maybe we'll see the market open and then just start to make a recovery. So I bought fairly early on this morning, and I bought at 11,875. 11,860 was the low. The DAX is quite a volatile market, so I put my stop at 11,840. The market did drift a bit lower. So at 20 to 9, the market was down at 11,850. So it moved a bit lower. I bought in here, and since then we have seen something of a gradual recovery. So whilst it's a trade that so far is in profit, I don't think it's that good a trade. It's too bottom picking, and second guessing what the market was going to do rather than waiting for some sort of confirmation. One thing I do when I do trades and I record them, I think it's really important to record your trades so you can go back and see, is there a common mistake that you keep making. One thing I do, clearly I put in where I got in, my stop loss and my target, but what I also do for the stop loss, I've got a column that says how long ago, it doesn't say it this way, but how long ago was the low below where you're placing your stop loss, because my view is if I can get it below yesterday's low, that gives me a lot of wiggle room, but I want to have a fair bit of time. And I placed that stop loss this morning, and the low was made sort of 25 minutes earlier. And as I was typing it into the spreadsheet after I'd done the trade, I thought this is far too early to be doing this trade. I'm basing it on a level that wasn't even there half an hour ago. So that's why I think today this trade has been a pretty it's not a good textbook example of a good trade. So let's see what happens the rest of the day. But clearly it's all going to be US market led. So I think we are in for an interesting couple of days, but maybe a boring day today as everyone has a bit of a hangover from the day before. Right, let's talk about currencies. It's interesting things as ever going on in currencies. We're going to look at three. Let's start off by looking at the pound against the dollar. Now, pound against the dollar is very much, I think as I say every week, this is very much a market that is driven by the political reality at the moment, rather than any great fundamental gubbins. Let me flip this chart over. I think last week, what I was saying last week has turned out that I thought maybe the move down had been overdone. The pound has got lots of support whenever it dips back towards these old 120 levels, and last week we dipped to 121. There seems to be an appetite to be a buyer pound against the dollar down here, and then on the upside, whenever it starts sort of pushing up to 127, 128, the sellers come back out. At the moment we're in the middle, so for me, I don't think there's a trade there to be done. The stochastics tied it up as well last week, so they've worked not too badly there. Bit of bullish divergence in the past on the stochastics. The market hits a low, moves lower still. Stochastics are trending higher, and at the moment it looks like we could get a hook over and a sell signal in the next couple of days. But for me, there probably isn't a trade. There isn't a trade there. What am I saying? It's in the middle of that range. So down here we want to be buyers, up here we want to be sellers. And I suppose until we get a lot more clarity on what Brexit means and everything else, chances are we'll just carry on chopping into this range. But I would rather be a buyer than a seller of the pound. I do think my bias is that some of the weakness has been overdone. Let's see what happens. If we flip over to an hourly, I don't think we're going to see a lot more on the hourlies than we've got at the moment. I mean, you could argue, if you had to do a trade here, you could argue that the trade to do is to be a buyer, okay? Because just this morning, the early hours for me of this morning, 6 o'clock, the market did push a little bit higher and extended that recovery from about 10 days ago. And we've got pockets of an aggressive trade would be we've sort of dibbled down to those lows from yesterday afternoon, and they've held. So 124.40. The market's currently 124.57. So if you want to be really aggressive, you could be a buyer looking for a move back up to 125. So I suppose on the hourlies, there's still a trade there, but the bigger picture, we're a little bit in the middle of the range, I think. So I think there are maybe better opportunities out there. Let's talk about the euro. I think I noticed this week a lot of banks have revised their forecasts for the euro. It's human nature. Whenever a market is going one way, like we had in the euro beginning of this year when it briefly broke below the lows from last year, human nature seems to be to just extend that out and think, well, okay, the market's fallen, it's going to completely collapse. Maybe the same way as we've had in recent months with rising stock markets. Some people might have thought, well, that's it, market's going to carry on going up forever, it's a new paradigm. So plenty of banks have revised their bearish views on the euro this year, and we have seen in the last week. And we have seen, again, a really solid recovery this month from the euro. From the lows of around about 105 up now, sort of sniffing around about the 108 level. 300-point rally in the euro. It's been a good month, but we're back in a good month for the euro. But we're back in the danger zone again, I think, for the euro. Again, if you wanted to be a buyer, like a medium-term buyer of the euro up here, I say it from a risk-reward point of view, It doesn't look fantastic. If we look at these levels, we pick off these levels from December last year and Jan this year. So 108.30 to 108.75 has been like a real graveyard for Euro bulls. It's run out of steam, and you can see just today we're seeing a little bit of weakness. So I think that's a really interesting area to watch for the Euro. Clearly, if you were bearish on the Euro up here, if you wanted to go short the Euro, in terms of risk rewards, it's a good area. Because by definition, if the market breaks through these levels, you're wrong. But you've got a risk of, I don't know, 100 or so points if you're going to go up here with your stop, and then potentially 300 points on the downside. So for a medium-term trader, it's an interesting risk reward up here. But this is clearly the band to watch. On euro dollar, these old highs. Let's see what happens. If we break through here, we can start gunning for these old levels back here, back into the range from sort of August, September. So this whole 108.30, 108.75, let's call it 109 and round it up. Is really the area to watch on the euro. Let's flip it over to the hourly charts. Here we go. So on the hourlies, if we plonk our trend line on, I'm sure that trend line is still chugging away. There we go. So on the hourlies, for the shorter term traders, there's the argument to still be a buyer on dips. Our little stochastic, how's that performed? Buy signal March the 20th, that was very nice. Buy signal here, that was okay. Buy signal there, but not really oversold, so probably not. Down here, that was all right. Oh, look, it's just been working its magic. It's been right about, I don't know, 3 times out of 5. And already it's hooked. It's hooked over. Is that this morning? 6 o'clock this morning, it's hooked over, giving a buy. And it looks like maybe if we get another buy here, we'll have a bit of divergence. But the closest I would want my stop if I was doing a trade on the hourly chart would probably be the other side of these levels that were pretty solid, 107.05, 107.20. So let's see if it sold off from here and showed a bit of strength. It could be interesting, but I just think you just need to keep a bit of a beady eye on what's going on in the longer term time frame, and just be aware we're back up to levels that maybe have been quite a problem over the last 3 or 4 months for any further euro progress. The last currency we'll look at, and then we'll have a quick look at gold and oil, is dollar yen, and it sort of bears up what we're seeing in the euro chart. Dollar yen's really interesting. We had that fantastic move October through to December, and the market sold off. But as usual, I'd be expecting it to bounce its way back up, but it's not. And I think there are some really big levels to watch on dollar yen. There we go. That 111.35 support. We're 10 points below that now. But again, let's see what happens. Dollar yen. If it's going to bounce from anywhere, if we're going to see a dollar come back, then this is the level. So let's see how the market performs down here. So potentially, euro dollar, dollar yen is in a turning point for the US dollar, but we're not seeing it yet. But there are, I think, some interesting levels to watch on that. Let's take a look at oil. Let's have a look at Brent crude oil. We've got a bit of a longer chart here. Let's what can we have a look at? Is this the dailies? This is the dailies we're on. So we've got our Brent crude oil going back quite a way here. It's been odd, I think, oil. I mean, I think I've said in the past, it's always a market that has wrong-footed me when it comes to trading it, oil. So I don't trade it very often, but it's been quite weak. So at the moment, this is the May contract trading just above $50 a barrel. After being up at 58 end of the year, end of last year. There's still lots of support. I think the recovery from those lows from last year is still intact. Lots of support on the dailies down here. I think 44 and 42. So for me, I still favour a move for oil up, but it's just had a bit of a week or so. Let's take a look on the hourlies. I think we've got oil inventory data out this afternoon. I think this afternoon, comes out every Wednesday. And you can see it just started to drift a little bit lower. So for me, I still favour a snapback in the price of oil, but at the moment it's a market that's still weak. Something that is more interesting is gold. We talked about last week, when I looked at, let's just take this out to maybe a 4-hour chart. We'd had that great run from December, the December lows, around about 12.20 an ounce, up to 12.58, 12.60 by Feb. Then we saw the market correct a bit, and I think this time last week we were looking at that that downtrend, and I think it it was maybe on the verge of breaking, but not quite. And I think we also had Aussie dollar as well. And as the day went on, it moved outside the downtrend. But it was the Fed last Wednesday, wasn't it? The Federal Reserve that really altered the trend in gold. When they came out, they raised rates as expected. I think there had been some caution in the market that we're expecting another 2 rises this year, but maybe the Fed will signal there'll be more. The fact that they didn't put pressure on the US dollar, so push the dollar down, push the likes of gold, the euro, the pound, everything else up, and it just took off like a rocket, and it hasn't really looked back. So for me, again, there probably isn't a trade there. You know, I still think we'll see the old highs taken out, you know, as long as this old support down here holds at 1180. But the better trade for me in gold, from a risk reward point of view, even though I think it's going to move higher, if it sold off and just cooled off a bit and came back down to maybe 1210, because there's an obvious place for the stop below those lows, 1194, or even below these lows out here, 1180. But for me at the moment, it's a bit, my stop loss would be a little bit too much finger in the air. And I think that's it. I think let's start wrapping things up. I think clearly the markets to watch the next couple of days are these stock markets because of the move that we saw yesterday. Let's see what sort of day we have today. My money would be on a quiet one. Let's see if these old support levels from Feb can hold, and let's see if the markets can start and claw back some of that big fall we saw yesterday. Clearly, if these levels start to lose, you know, we have to, you know, that bullish view, that short-term bullish view, goes out the window if we start to drift below these levels. But I think it has made things a bit more interesting after the big slide yesterday. I think I tweeted something out earlier today. It was a tweet that somebody did about a week ago, and it was about how markets react after long unbroken runs. And it was when the S&P finally drops 1%, it will go on to lose over the next 5 days about 1%. So if you have a look at my Twitter feed, you'll see it there. So it would suggest, which again wouldn't be surprising, after a big shot like yesterday, the next 5 days, you know, could see further market weakness. But I think today, well, let's see what happens. Maybe a bit of a quiet day, and maybe an attempt to at least claw some of it back. But we'll start wrapping things up there. I'll just put my contact details up if I can figure out what I'm doing here. Here we go. There we go. So if you have any questions, drop me an email. My email address is david@tradeafter.com is the best one for me if you use that. And follow me on Twitter for sort of half interesting charts and stuff. And I'm at Jones the Markets on Twitter. So if you and I do, if any sort of big levels are threatened, I do try and post this stuff up. And on the social trading side of things, I've started writing about running a real social trading account with a couple of £1,000 in, and that's on tradeafter.com. That's where they are, though. So I think that's it. But definitely all stock markets, I think, for the next few days after the shock we had yesterday. So hopefully we should have an interesting end to the week. We'll stop things there. I'll do it all again next week, and I hope you have a good week of trading, and hopefully you'll be back here next Wednesday.